Morning, everyone. We're here today. I'm going to be interviewing Mr. Brian Smith here. We're going to be talking about inflation, finance, biblical worldviews, and a lot of different other topics relating to mainly inflation, the Great Depression, and if we kind of see it coming back around today, and also applying those biblical foundations that Jesus gave us through his teachings. So today I have here with me Mr. Brian Smith. So just tell us a little bit about yourself, Brian.
Okay, Brian Smith. I've been in the finance world for some time. Actually, starting when I was in high school, I served as the treasurer for a number of different organizations. Future Farmers of America. I was in the Interact Club. It was a volunteer organization. So from an early age, I wanted to be involved in the finance part of any organization I was a part of. Carried that over into college. The Farm Bureau, Young Farmers and Ranchers, I served as the treasurer there. And then when I got out of college, I went to work at the Department of Education, working in the student loan division. So I managed not only a substantial portfolio of student loans, but I also worked with state grants and scholarships. And the way it would work is our portfolio would generate the money that we could put forth to help with the state grants and scholarships. After that, I began working for myself as a financial advisor, worked for Northwestern Mutual, Mass Mutual. Now I'm independent. So yeah, that's where I'm at right now.
Okay. So now you also have a history or a background in history. Can you just talk about that? You know, what degree did you get, and what kind of inspired you want to go the history route?
Correct. Yes, absolutely. I majored in history in college. I have a BA in history. Teaching has always been a passion of mine. I've always enjoyed teaching. So when I got into college, I picked a subject that I enjoyed. I've always been fascinated with history. I was never one to be able to put down a history book. So that's what I majored in. So although finance is my career, I would say history is more of a passion for me, and teaching in general.
Okay. So now trying to close in this triangle here, we got history, we got finance. Talk about your walk with Christ. Kind of how did you get into that, and also how do you apply it to your other two jobs as well?
Sure, absolutely. I was a Christian from a young age. I was born and raised in the church, so it's always been a part of my life. But once I started applying it to my life, really high school, college, I began to see, okay, there's certain principles that are outlined in Scripture that are non-negotiables. And one of those is discipling, teaching others about Christ and the gospel and teaching them Scripture. Another one is that many people don't talk about, and that's being fiscally responsible, or responsible with whatever the Lord has given you. That could apply to finances. It could also apply to other gifts that He has given you. And that's actually talked about quite a bit in Scripture. Although it's given in the context of finances many times, it's the underlying theme is really any gift that God has given you, using it wisely and using it, you're not taking advantage of it or wasting it.
Okay, all right. And just kind of to transition, so now we've laid the groundwork, who you are your qualifications. You're obviously certified in all three categories. So now kind of just let's start painting a picture here. So what is interest rates, or what are interest rates?
Interest rates, the easiest way to explain an interest rate, and I'm going to really narrow this down, is it's how much you pay for, let's say, money. So in other words, if you want to purchase a house, the lender's going to say, okay, we'll give you $200,000 to purchase your home with. The interest rate is the fee that you pay for that money, and that's you see it in the form of it usually tacked on to every payment that you pay. So if you're paying a 5% interest rate, it's 5% is what you're going to end up paying in the long term for borrowing that money up front. So as opposed to if you have a lump sum of money you pay up front, you can avoid the fee, or if you don't want to wait and you want the money now to pay for whatever, whether it be a car, whether it be a mortgage, then you can, the interest rate is, or I don't want to call it a penalty because it's not, it's a fee that you pay in order to get that up front.
Okay. And so how the next portion of this is like, what is inflation? I hear those two terms a lot. Are they related in any way?
They can be related.
Okay.
Inflation is the price. But I'll give you a simple answer here. General increase in prices of goods and services in an economy. So, an inflation is the price that our money, or the price that we pay for certain goods. So, when you go to the grocery store, you're buying a loaf of bread for $2. Next year, it's $3. You do the math, and you'll figure out, okay, the increase in price is what they call inflation.
Okay.
So, and you see it generally as a percentage.
Okay, I gotcha.
And then as far as how does interest rates affect that, they can be correlated without getting too far into the weeds, and I know we're going to go into that here in a minute. But generally, what the feds do when inflation is rising is they will increase interest rates in the attempt to slow down inflation, because by increasing interest rates, then money isn't as cheap to borrow, and so that's going to slow down that sector, and essentially the theory is that it would slow down inflation. So in that instance, you can see them kind of correlating with each other, and they use the interest rate as a tool to attempt to slow down the rise of inflation.
Okay, I gotcha. So then so the Fed or the government can kind of suppress inflation just a little bit by just tweaking some things like interest rates and that kind of stuff. Okay, so I didn't know they had the ability to kind of control I knew they had the ability to control the markets, obviously, but not to that extent. Okay, so we talked about interest rates and how we talked about the government affecting them, but how do they affect? Let's start small first. So like your local credit union, or up here we have Centennial Bank. How does interest rates on a local level affect the consumers like you and I?
As far as on a local level, when you're talking about interest rates in general, even your local banks, it's all coming from the top. So the feds will set the interest rate, and then generally your local lenders, they adhere pretty closely to the interest rates that's set by the feds. And with mortgage, I wouldn't say that there's, I don't want to say this again, I don't want to get too far into the weeds, but when it comes to your local lenders and mortgages, most of the time when you go to a local bank, and if they're going to write a mortgage, they may write it, but they immediately sell it to a larger lender such as Chase. So very few of your local banks actually hold on to mortgages and really benefit from that. So yeah, I know that didn't really answer your question, but
it kind of did.
Yeah.
Okay, so the more of the controlling of interest rates is a large government, kind of large business, large bank kind of thing.
Correct. We're looking at it that correct.
Okay, now you may not know this one. This is just from my own curiosity, but has it always been that way? Because I feel like back in the 1700s, 1800s, you had more power with the local banks, and they kind of controlled their more stuff. So
that's the truth.
Okay,
this came into effect after after the stock market crash. There were you're right. There were certain things that were put into place, and we'll get into that in a minute. But they were put into place to help prevent a crash like that from happening in the future. So what it is we saw this crash, like, oh man, now what do we do? So they went back and they started developing different safeguards, different guardrails to not only maybe predict when that could potentially happen again, but also to help prevent it from happening in the first place.
Okay. Yeah, we'll get into some of that as well. I know you probably have notes all day on this, but so we kind of talked about it a little bit, but just explain it on just a nuclear rudimentary level about what is the ultimate cause of higher interest rates. You kind of talk about supply and demand a little bit, but with the bread, but just kind of talk more on that and just about the higher interest rates and how it causes kind of more of inflation.
Okay. Yeah, there's two causes of inflation. For the most part, you're going to have two causes. One is called demand pull, where there's a high demand for a product, which causes an increase in prices. And so that would be called a demand pull.
Mm-hmm.
So it's based on demand. The other is a cost push, and that's where the cost to produce a product increases. So, for instance, if the price of oil increases significantly, that's going to mean that the producers, it's going to cost them more money to produce a product, and therefore that cost is going to go up to the one purchasing whatever product it happens to be, which pretty much everything is affected by the price of oil.
Okay.
So you have two different types of inflation. There are two different causes. Now there may be others, but those are the two main ones that we'll focus on. So demand pull, cost push.
Okay.
Both of them, demand pulls inflation up, pulls the cost up, and then cost pushes it based on an underlying cost to produce the product.
And now with the reverse of those, cost pull, demand push, would those be things at lower interest rates?
Correct.
Okay.
Mm-hmm.
Gotcha.
Right.
Now, is that something the government can kind of control, or is that just consumer-based driven?
It depends on who you talk to. Government can control a lot, whether they admit it or not. They can.
Mm-hmm.
They can the price of oil. They have control over that. What we're seeing now in our current environment is one of the big arguments is we have the ability to produce more oil, but there's a push in our current legislation preventing a lot of that from happening.
Mm-hmm.
And so what you end up having to do is you're either dependent on a foreign entity to provide your oil for you, or it's just going to cost more because the demand is a lot higher for the small amount that we have.
Mm-hmm.
If that kind of makes
And
sense.
so you mentioned the price of oil kind of controls everything else. Is that just because of any kind of product you have, it's got to be shipped there and it's got to be transported? Is that kind of the root of that?
Pretty much, because you figure
Okay.
the factories they're made in, the transportation it costs to get them from point A to point B. What kind of transportation is there that doesn't use oil of some sort? Diesel fuel, something of that nature. So
Okay.
yeah, and then just the production in general.
Mm-hmm.
Oil is really, it's tied into pretty much everything that we produce.
Mm-hmm.
So that's just one example
Yeah.
of how the government can potentially change that or not. Sometimes it's out of their control. Most of the time these days, I would say that it is in their control to do something.
Okay. And so let's get more to the bulk of the topic here. So we know the stock market crash of 1929. We know some things that were leading up to it. How much of a role was interest rates, and how much of a role did the interest rates play in that cause of that crash?
There are a number of different trains of thought as to what actually caused the stock market crash. To answer your question, and the interest rates did, it was more of the availability of money. So interest rates were down low for a long period of time, which made you had lenders who were lending out money hand over fist. And being as it was cheap money, you had a lot of people taking advantage of that. And so what ultimately happened, according to some economists, is that there was too much money lent out and there wasn't enough to back it up.
Mm-hmm.
And so in that effect, yes, if interest rates could have been controlled more, then it could have potentially prevented the stock market crash to take place. So again, you had a lot of money out there that was available, and it was very cheap. When interest rates are low, that's cheap money. So other causes, I mean, there were many other causes. I don't want to get too far into the weeds here, but as I said, there is one train of thought that believes that is one of the causes, was the availability of cash and the low interest rate for a long period of time, and there just wasn't the cash to really back that up.
Okay, I gotcha. And so talking about that with interest rates, because it's obviously, if you turn on the news today, you can't avoid inflation, interest rates. Those two things right there are big pushes in the market now. So what kind of similarities do you see from your professional financial perspective? Do you see any similarities shaping up in today?
Potentially, you do. The main difference I would say is now we have safeguards in place. We've learned a lot from the stock market crash of 1929. Almost immediately after that, just within a few years, they began passing more regulations to help manage the financial markets in general. So you had the Security Exchange Act of 1933, then after that 1934, where they not only regulated the exchanges themselves, the New York Stock Exchange, the NASDAQ, those, but also they began regulating the stocks, what kind of stocks could actually be sold. They had to make sure they were legit, and then also who can sell them. So they began in the 1930s. You started seeing Congress saying, okay, we see some of the issues that really caused this. What can we implement to help prevent that from happening again? So over the years, you've seen things like that, or legislation passed that have helped really prevent it from getting to that point where it just completely tanks and crashes. So, and there's a lot more people now that are monitoring it, and so they can see ahead of time. They can look at a trend and say, okay, we're getting a little too close over here. We need to do something about that. With the current situation with inflation, one of the yesterday the Fed raised the interest rate again by 75 basis points, 0.75%, and one of the criticisms of the administration is that they waited too long, or the feds or whoever, they waited too long to do something about it. So now it's they're in a situation where if you raise interest rates too quick, you could really jolt the economy and almost cause it to slow down too much, because the economy is like a freight train. It's hard to get it going when it stops. So the goal is to keep it going, but learn how to slow it down and speed it up, and keep it within a target range
without stopping it.
Correct. Without it getting too fast or without it getting too slow.
Okay.
Because once it stops, it takes a long time to get it moving again.
Yeah. Okay, so that makes sense. So the safeguard you're talking about, it seems like, because obviously, 2008 was a big crash, and then you had a little bit of, recall from that 2009, and obviously 2020 with COVID was a big crash. But you don't have the lasting effects of that, like, the 1929 stock market crash. It was like 10 years after that where everyone was, you saw the bread lines and all that kind of stuff. So I guess the safeguards are preventing us from having that fallout for decades behind.
Correct.
Gotcha.
And there's also, other things that played a part into that. 2020, it wasn't the economy itself that was affected. So it was a situation outside of that. And so that was a little different. But what you see, and what many believe is the cause of the inflation we're seeing today, is the government poured a ton of money into the economy to keep it going. That's something they did not do in 1929. And so that was one of the criticisms looking back, is they said, well, the government could have pumped some money into the economy to kind of keep it going, keep consumer confidence up, but they didn't. And so people that did have money didn't want to spend it because they're looking around thinking, oh boy, I got to hold on to everything I have. And then jobs were being lost, and the government wasn't doing anything really. So that was one of the criticisms. Then you see in 2008 was all the bailouts and everything. Agree or disagree, their thought train was that if we don't dump money and bail out these companies, the economy will crash. And so that was their reasoning behind that.
Okay. So now I noticed there was a lot of the stimulus checks and all that kind of stuff. I get that was kind of to help the economy, but is there a negative aspect to that where they didn't have the money? So let's say the government didn't have the money, so they just kind of created it and didn't have that backing behind it. Is there any kind of fallout recourse from that? Are we going to see that in the years to come?
You could, because that's many feel that's another cause of inflation is when too much money is being spent and are being printed. So the value of the dollar goes down. And that's really at its core what inflation is when a currency, the value of whatever currency you're talking about goes down. And so if there's too much out there, then that could cause the value to go down. And that's why interest rates, when they raise interest rates, then there's fewer people who are getting mortgages or whatnot. So the flow of money slows down. When you lower interest rate, the flow of money, it kind of opens things up. When the government pushes too much money into an economy, it does the same thing. So yes, there could be definitely long-term effects of that. How we're still looking to see. Inflation could be around a long time. Some economists say that it will be. Others think otherwise. So it's that's one of the arguments.
Okay, just kind of open interpretation, I suppose.
I would say more open to the agenda that you're trying to push.
All right, we'll just cut it there.
Yes.
All right. We talked about some defenses in place within our financial system. You went into good detail about that. So now let's kind of swing into the topic that I'm really ready to discuss.
Okay.
So what were some key principles that Jesus really pushed? Because I've heard some biblical scholars say that Jesus has talked about in all his parables, 44% of them mention something about finance. Now, some argue that was an analogy for something else, that he just used money because everyone knew about it. But nonetheless, there's a lot of good financial biblical principles he taught, and just kind of highlight some of those.
Correct. He did. The one that sticks out is in Matthew 24, where he talks about the owner, the farmer, that gave his servants, he gave 1, 10, 5, and 1 talent, I believe. I have to read it to get the numbers correct. But essentially, you have one that went and invested it and came back, and he got like tenfold. One that hid his under a rock, didn't do anything with it, and then another one that made a good profit. And the one that was looked down on was the one that put his under a rock and didn't do anything with it. So is it an analogy he uses? I think it is, but I think that you can also, I think there was an underlying, whether it be a gift that he's given us or whether it be finances, I think the point is the same. He expects us to use it and to get as much out of it as we can. If he gives us the gift of teaching and we decide we don't want to teach, then we're wasting that gift. We're essentially putting it under a rock and saying, okay, yeah, I'll come back to it whenever you get here. The same with our finances and our money. If we're not using it responsibly to further his kingdom, then I absolutely believe that's, I believe that it's a sin, personally. Some may disagree. I believe it's a sin if we waste the resources that he gives us.
Okay. All right. And then this may be really hard to be able to talk about. But there's really not a whole lot of data about it. The Bible's really the only resource we have. So did economic fallouts like the Great Depression, like in 2008 when we had that, did it happen during biblical times?
Not that I'm aware of, and I would say why. The economies back then were much different than ours. People were more individualistic, I would say. You had a farmer who he depended year to year whether or not he was going to get paid. And his investments were generally in something like more camels or more cattle, something of that nature. It wasn't investing it into a market like we see today. They were also, a famine could come along and wipe everything out, but that was completely out of their control. So whereas today we do have more control, I mean, we can choose to put it into the market and dive all in. We can also choose to put it into something that's more stable or more secure. That may not be as high of a return, but it's safer. So we still have choices as far as that goes. They didn't really have much of one back then.
Mm-hmm.
So I would say, did it happen on the scale that we see today? No, just because they were so entirely different as far as the economies are concerned.
I gotcha.
Especially in biblical perspectives.
Mm-hmm.
Maybe once you get beyond, after the New Testament and some of the more, the Roman Empire and some of those societies, you could probably have that argument. But maybe I haven't really done the research there, but yeah, biblical wise, I would say no.
Okay, I gotcha. And then, do you notice you've done a lot of financial advising over the years, from life insurance to all kinds of management within retirement funds? So, do you notice a correlation between individuals' faith and their finances? Do they once people let's just say someone surrender their life to Christ? Do they typically have better financial lives after that?
You have to be careful answering that question, because you have pastors out there that would say, you have faith in the Lord and He'll provide everything you need, and you'll live a life of having everything you want. No, I would say that when people are saved, their priorities change. So when you surrender your life to Christ, you're completely surrendering everything inside of you to Him. So now everything you look at is through His eyes, or it should be. If not, then you're still holding on to a part of your old self. Now, you're going to constantly struggle with that, because we live in the world and we're fallen human beings. So there are going to be struggles as far as how we approach things, the decisions that we make. But ultimately, when we're saved, we should now view things through the eyes of Christ. We look at people. Now, we should look at them differently. Before, we may have just like, that person's a piece of trash. Now we look at them through God's eyes, and it's like, no, they're a human being that has value. So I would say the same thing with finances. Before we're saved, it may be all about us. What pleases us.
Mm-hmm.
What's the quickest way I can get what I want? Whether it be a high interest loan, maxing out my credit cards, whatever I can do to get what I want now. That's the way many non-Christians think. That's the way of the world. That's the way the world teaches us. You deserve that. You have to have that. When you become saved, your attitudes change. It's like, okay, how can I use what I have to honor God?
Mm-hmm.
So yes, from that perspective, it should totally change.
Okay, I gotcha. And then, what kind of advice, if you were asked by the higher ups in the government, I know this is a loaded question, and everyone would wish to be in this position, but what advice would you give to the government to handle the current inflation and financial crisis that we kind of see looming? Everybody talks about it. If you go to YouTube, the news channels, everyone's talking about the looming financial crisis and kind of some of those things. So just what would you give the advice to the higher ups?
Well, there's, number one, it didn't happen overnight, and it's not going to change overnight. But there are a couple things that I would implement immediately. One is totally revamp the student loan process. When you're giving out that kind of money to students who have not been taught how to use it, you're asking for trouble. I mean, I've seen it. When I worked in that industry for 10 years, I saw how easily students could get thousands upon thousands of dollars without being taught the repercussions of what happens when you're done with college. What happens when that bill comes due? And so what ends up happening is you have the taxpayers who are on the hook for billions of dollars. I think now it's up to like $1.5 trillion. Maybe I haven't looked at it recently. But so that's one thing. But also, to me, the big thing is education. When we take in personal finance out of schools, that should be a requirement in every school in America.
I agree. And
teaching them not only how economics works, but the value of money and personal responsibility. If you borrow money, you pay it back. If you don't pay it back, these are the repercussions for not doing so. I think we've given too many parachutes for people that don't want to pay back the money that they
Yeah.
borrowed. But I think so much of it has to do with lack of education and how they just haven't been taught how to do it. They don't know how to balance a checkbook. They don't understand interest rates. They know how to pay sometimes they know how to pay the minimum on a credit card, but they'll get with student loans, for instance, they'll get a payment that is much lower than what they should be paying, and although it may be a qualified payment, that loan is going to continue to grow because you're not even paying the minimum payment. And so 10 years into it, they're like, well, why is my balance the same? Well, that's because you hadn't been paying a minimum, and that interest continues to build and grow and grow. So those are the two things that I would implement.
Okay.
Or immediately.
Yeah. Okay. And then the last question, this is just kind of my own personal curiosity because I've always wanted to dive deeper into this. But is a lot of the problems we have today or do we have more problems today because of this thing called credit? Credit cards came out. People can start putting money down, pay, get now, pay later. That's a big thing. A lot of stores are going to that. So we have this looming debt over us. And like you said, people don't have the financial literacy to be able to handle all that. So do you feel like that's certainly contributing to some of the problems we have now?
Oh, absolutely, without a doubt. The Bible says in Proverbs chapter 22, verse 7, just as the rich rule the poor, so the borrower is servant to the lender. We live in a society now where everybody has some kind of debt. Nobody pays for anything in cash anymore. You take it 150 years ago, it was flipped. Everybody, they would pay in cash. Houses were, if you owned a house, then you paid for it in cash, or you built it a little bit at a time. But that's just not the case anymore. As far as the credit goes, we live in a society where everybody's wanting to sell you something, and they're going to do their best to convince you that you need it right now. Well, most people, they can't afford it right now, and so what they've developed is credit cards or ways to purchase that right now. And so it's more than just the vehicles that are available to get that, but it's the underlying it's what's being taught to us, these attitudes of I need it now instead of let me save and pay for it, that I think is really starting to erode our society. Because at some point, the bill's going to come due, and somebody's going to have to pay for it. And people don't have that concept anymore. It seems like it's always somebody else's fault that they got into the mess that they've been in. I deal with it a lot, and I say this a lot. To me, it's not so much when I sit down and work with individuals, the teaching them the principles is the easy part. The most difficult part of what I do is changing somebody's attitude and changing their habits. Because if they have poor spending habits, they can pay off their credit cards, but in a month they're going to go right back. So really, I know I've kind of gotten to the weeds here, but I think that you really got to change people's attitude and how they view debt and credit in order to solve the bigger problem, because it's too readily available, in my opinion, but the demand is so high that for credit of any kind, that it's going to continue to be out there and be available as long as the demand is as high as it is.
I gotcha.
Okay. That makes sense.
Yeah, no, that definitely helped me kind of answer that question. Well, thank you for answering all these questions. You have certainly given me more than I can chew on right now. But thank you again. Hope you learned something watching this video, and thank you very much for watching.